Swayam Prabha. Digital India. Educated India.
Yoga Karmasu Kaushalam.
Friends, Namaskar. My name is Dr. S.C. Sardar, retired professor, SD School of Commerce, Gujarat University, Ahmedabad. Friends, at present we are dealing with final accounts of sole proprietary concern. Under this title, at present we are observing preparation of final accounts. Today we will deal with the Part 6. Let us recollect discussion of Part 5. In Part 5, we have acquired information about on comprehensive illustration on preparation of final accounts with effect of studied adjustments. Some other adjustments with example like bad debts recovered and BDR and their different situation with accounting treatment. Now in Part 6, we will study some other adjustments like provision for discount on debtors, manager's commission, interest on capital, goods withdrawn for personal use, goods distributed among staff for their welfare, and abnormal loss of materials. In continuation of adjustment, now we will see adjustment number 9. Adjustment number 9 is pertaining to provision for discount on debtors. To receive early payment from debtors, sometime businessmen provide discount to debtors if payment is made by the debtors in stipulated period of time. The process is the same as for the provision for doubtful debt. The expected amount of the discount to be allowed is debited to profit and loss account and credited to provision for discount on debtors account. The balance in the latter account is deducted from books debts in the balance sheet and is carried forward to the next year. Actual discount allowed next year is debited to provision for discount on debtors account and not to the profit and loss account. We should remember that from debtors first BDR is provided and subsequently provision for discount on debtor is made. Let us see one example. On 31st March 2025, closing balance of debtor is 90,000. In adjustment, BDR at the rate of 5% is to be maintained and 2% provision for discount reserve is required. Let us study the accounting treatment for provision for discount on debtors. Rupees 90,000, from that we will deduct 5% BDR first, so that comes to rupees 4,500. We will have balancing figure of 85,500 and from this 2% discount reserve rupees 1710 will be deducted. So, here profit and loss account will be debited by 1710 and it will be credited to provision for discount reserve on debtors account when provision is made. Then whenever discount is allowed, discount allowed will be debited and debtors account will be credited by the same amount. Now, the next journal entry is about provision for discount on reserve account debited rupees 1710 and to discount allowed is credited by 1710. So, here what happened friends, now discount account we have closed and this discount we have transferred to the provision for discount on debtors account. Now, disclosure in final accounts. In profit and loss account, the whatever new BDR we have created of rupees 4,500 will be disclosed. Simultaneously, the provision for discount reserve on debtor also will be shown over here 1710. Now, the effect in the balance sheet, asset side debtors we are having of rupees 90,000. From that first BDR is to be deducted because this BDR is given to us in adjustment. Now, we are having balancing figure of 85,500. From this discount reserve of 1710 will be deducted because discount reserve is also to be created and given in the adjustment. Therefore, the final amount which comes to us, that is 83,790. Now friends, the next item is manager's commission. Sometimes business firms allowed commission to the manager with regular salary. This commission is paid as a fixed percentage of profit. It is also a component of salary to be paid, calculated on the basis of profit. Hence, GST is not levied on it. Commission as a percentage of the net profit, it may be payable on profit before charging the commission or on the profit after charging the commission. Let us say these two situations. Manager's commission payable on profit before charging the commission. Manager's commission in this situation is calculated by applying the rate of commission on the amount of net profit. Suppose profit earned by the firm is rupees 2,10,000 without charging manager's commission, which is payable at the rate of 5% on net profits. So, commission allowed here will be of rupees 10,500. Therefore, as the amount of commission, that is rupees 10,500, is still to be paid, it is treated as an outstanding expense. Accordingly, the entry will be passed like this: P&L account will be debited by rupees 10,500 and to manager's commission payable or outstanding commission account will be credited by 10,500 rupees. The formula to calculate manager's commission in such a case is net profit before charging commission into percentage of commission divided by 100. Here our profit is of rupees 2,10,000 and 5% commission is allowed. So, into 5 divided by 100, that comes to rupees 10,500 rupees. Manager's commission is shown as an expense on the debit side of profit and loss account, and manager's commission which is payable as a current liability will be shown in the balance sheet. Now friends, we will see the second situation where manager's commission is payable on profit remaining after charging the commission. If commission to the manager is to be paid on net profit after charging such commission, it will be calculated on the basis of given formula. Here we have taken into account percentage of commission which are given to be divided by 100 plus we will add the percentage which are given to us of commission and to be multiplied with net profit before charging such commission. In given example, the commission will be calculated like this: manager commission is given to us 5%. So, here 5% will be divided by 100 plus 5 into rupees 2,10,000. So, that comes to rupees 10,000. This may be verified. See here friends, after charging commission, net profit will be rupees 2 lakh. Here rupees 2,10,000 minus rupees 10,000, that comes to rupees 2 lakh. So, 5% on 2 lakh is equal to rupees 10,000. Now, the next point is given to us: interest on capital. There can be a provision to pay interest on capital. Funds invested by a proprietor of the business constitute capital. Profit arrived after charging interest on capital shows real earning efficiency of the business. Adjustment entry is passed by debiting interest on capital account and crediting capital account. Interest on capital account being an expense account, it is transferred to profit and loss account. So, here interest on capital account will be debited as an adjustment entry and will be credited to capital account. Then after friends, it is an expense and we have to close this account. So, closing entry to be passed. So, profit and loss account will be debited to interest on capital account will be credited. Friends, see the notes over here. If interest on capital is given in the trial balance, then it will be charged to profit and loss account only, as the entry for crediting the capital account is already passed. Number 2 is interest on capital is allowed on the balances in the capital account in the beginning of the accounting year. In case of proprietor introduce fresh capital during the accounting year, interest on capital is allowed from the date on which the capital was introduced till the end of the accounting period. Let us understand this with the help of one example. Mr. X has introduced capital of rupees 5 lakh on 1/4/2024 to commence a business. On 1/1/2025, he had introduced additional capital of rupees 2 lakh. 5% interest on capital is to be provided. Final accounts are prepared on 31st March 2025. In this example, interest on initial capital for 12 months and on additional capital for 4 months from 1/1/2025 to 31st March 2025 will be calculated. On rupees 5 lakh at the rate of 5%, interest will be calculated for the entire year, that comes to rupees 25,000, and then additional capital is introduced of rupees 2 lakh. On that, at the rate of 5%, 3 months interest will be calculated, that comes to rupees 2,500. Thus, total interest comes to rupees 27,500. Now, we will disclose this in our final account. So, here profit and loss account will be debited by rupees 27,500 as a expense, and the second effect will be shown in the balance sheet. The whatever additional capital is brought to be added in the initial capital plus whatever interest is to be paid, that is also to be added over here. So, that comes to 7,27,500 rupees. Now, another point is about adjustment, that is about goods withdrawn by owner for personal use. Friends, be careful for this point, because that is some effect of GST also to be seen. From business, owner may withdraw goods for personal use. In this situation, drawings account is debited with the cost of goods, because the goods used for personal use is drawing, and purchase account is credited because cost of such goods is used in decrease in purchases. The reverse effect of GST also passed to the extent of goods withdrawn by the owner. To that extent, paid GSTs are to be cancelled. Hence, GST paid on these goods is reverse. The adjustment entry is to be passed. For example, Mr. Baldev is cloth merchant in Baroda, Gujarat, and purchasing goods from suppliers of Gujarat, that is intrastate purchase, and from suppliers other than Gujarat, that is interstate purchase. He has withdrawn some cloth for his daughter. From intrastate purchase, he has withdrawn goods of rupees 15,000, on which 18% GST is paid, and from interstate purchase, withdrawn goods of rupees 10,000, on 12% GST is paid. Friends, kindly note over here, the total intra and interstate purchase of Baldev is of rupees 15,50,000. His capital is of rupees 6,50,000. Now, here what happened? He has withdrawn the goods of rupees 15,000 plus 10,000. So, here drawings account is debited by 29,500, but withdrawn is of rupees 25,000. So, here friend, kindly note that here we have to cancel the amount of GST, and that is why the total amount including GST we have to cancel and to be debited to drawings account. Therefore, drawings account is debited by 29,500. Purchases will be cancelled by 25,000, as I told you, 15,000 from intrastate and 10,000 from interstate. So, whatever purchases you have cancelled of intrastate, on that we have to cancel CGST and SGST, and therefore it is credited. So, to input CGST account and to input SGST account 1,350 and 1,350. At the same time, he has withdrawn goods from the interstate purchase also of rupees 10,000, on which he has paid 18% GST. So, here we have to cancel IGST. Therefore, to input GST account we have credited 1,800 rupees. Friend, take a note over here, goods withdrawn for personal use not available for sale, and thus output GST will not be collected and input GST cannot be set off against sale of other goods. Thus, in the such a cases where sale is not going to happen, applicable input GSTs are cancelled, and for cancellation their account we have to credit them. These cases are goods withdrawn for personal use, goods destroyed by fire or accident, goods given as a free sample, goods given for staff welfare also can be taken into account in the same manner. Now, disclosure in an account, friends, here total purchase of Mr. Baldev is 15,50,000. From that, we will deduct the purchase of rupees 25,000 which is withdrawn by the owner for personal use. So, net purchase will be of the year will be 15,25,000. And P&L account, we will not have any entry, see here, because there is no any transaction pertaining to profit and loss account. Then after we will see in our balance sheet, we are having capital of rupees 6,50,000. From that he has withdrawn the goods. So, 29,500 will be deducted from the capital of owner. So, total net capital remain left is 6,20,500 rupees. Now, the next adjustment is about goods distributed among staff for their welfare. Goods may be distributed among staff free of cost for their welfare. In this situation, staff welfare expenses account is debited because it means it is increase in indirect expenses, and to that extent we have to reduce purchases. So, purchase account will be credited. Then after friends, simultaneously we have to cancel the GST also. Applicable GSTs are to be cancelled. If CGST and SGST are applicable, then are to be cancelled, and if IGST is applicable, then IGST is to be cancelled on such a good. Now, let us see one example. For example, Mr. Jayas of Ahmedabad has distributed goods of rupees 70,000 among staff. These goods were purchased from Kirit of Jaipur. GST rate is 12%. Now, friend, this goods is purchased from Jaipur, so it is our interstate purchase. Now, we have to pass the adjustment entry for that, and in that case, staff welfare expense will be debited by 78,400, including effect of input IGST, because to that extent we have to reduce input IGST because we have not made a sale of this good. So, staff welfare expense account will be debited by 78,400 and purchase account will be credited by 70,000 and input IGST will be cancelled by 8,400 rupees. Now, friends, it is our adjustment entry, and for adjustment entry we have to pass closing entry also. So, profit and loss account will be debited by 78,400 to staff welfare expense will be credited by 78,400 rupees. The twofold effect of this entry is, number one, it is shown on the credit side of trading account or deducted from the purchases, and it is shown on the debit side of profit and loss account as a staff welfare expense. And third effect is, that is about input GST. If it is intrastate, then CGST and SGST are to be cancelled, and if it is a interstate purchase, then IGST is to be cancelled. Now, we will see the another adjustment, that is about abnormal or accidental losses. There are two types of losses, normal loss and abnormal loss. Normal loss is inherent loss and depending upon the nature of raw materials. A normal loss is a loss that is expected to occur during the production process. It is unavoidable and is part of the normal manufacturing costs. For example, wastage, seepage, shrinkage, spoilage, evaporation, leakages, breakdown, etc. are the examples of normal losses. Normal losses are part of the production cost and are not charged separately. Second one is abnormal or accidental losses occur because of fire, accident or earthquake which may damage or destroy assets of the firm. In such a case, the assets account is credited and the profit and loss account is debited. Stock of goods may also be damaged or destroyed by the fire or due to some other reason. Thus, the value of the stock will be lower, resulting in fall in the gross profit and net profit. Friends, further note, also input GST, that may be CGST and SGST in case of intrastate purchases or IGST in case of interstate purchase. Meaning thereby is GST paid on purchases of these goods is reversed because input GST on these goods cannot be set off against output GST. Loss of stock is credited in trading account with the cost of goods destroyed. If goods destroyed are not insured, then cost price of the goods destroyed is debited to profit and loss account. If the goods are insured, then the claim admitted by the insurance company is debited. And in the third case, if goods are insured and partial claim is admitted by the insurance company, amount admitted by the insurance company is debited to insurance company account and remaining amount is debited to profit and loss account. Let us understand these three situations with the help of one example. A company has a goods of rupees 1,20,000 and is destroyed due to fire, and this goods was part of intrastate purchase. Intrastate purchase, be careful, and 18% GST is paid on this goods. For the given option, explain accounting treatment and disclosures. The first case is given to us, goods were insured and full claim is admitted by the company. Number 2, goods were insured but only 60% claim is admitted by the insurance company. And the third case is goods were not insured. Now let us understand all these entries one by one. Now see the adjustment entry for the first case. Here the total 1,20,000 loss is admitted by the insurance company. So, loss of stock by fire account will be debited by 1,41,600 including the effect of input GSTs which are to be cancelled. Then trading account will be credited by the cost price, that is of rupees 1,20,000. It is our intrastate purchase, therefore, CGST and SGST are to be cancelled. Total rate is given to us 18% to be divided into two cases, that is for CGST and SGST 9% and 9% to input CGST will be cancelled by 10,800 and to input SGST will be credited by 10,800 to cancel it. Now, see friends, here what happened, the entire claim is admitted by insurance company. So, we have to collect the amount of rupees 1,41,600 from insurance company. So, insurance company account is debited, to loss of stock by fire account is credited 141,600. So, this account will be closed. Claim is admitted by the insurance company and claim becomes receivable and loss of stock by fire account is closed. Now, what happened friends? First, the insurance company will admit your claim and then after payment will be made by the insurance company. Now, when company will make the payment to us, bank account will be debited by 1,41,600 and insurance company account will be credited by 141,600. So, here the insurance company account is closed. Friends, disclosure in final accounts. Here we have cancelled the purchases by rupees 1,20,000, that is why we have credited. We have cancelled CGST and SGST also, and that is why we have credited both input CGST and SGST. It is not a sellable because these goods are not in existence. Now, we will see the third case, insurance company account we have debited because we have to collect it from insurance company. Then after next point we will see that full insurance is received, so no amount of the loss is remained left, thus P&L account is not affected. Now, we will see second case, when goods were insured but only 60% claim is admitted by insurance company, where loss is of rupees 1,41,600 and 60% claim is admitted, it means that comes to 84,960. Thus, business will have loss of rupees 56,640 rupees. Now, friends, we have to pass the journal entry for this. Here, we have loss of rupees 1,41,600. So, loss of stock by fire account is debited by 1,41,600 and then after the trading account will be cancelled by 120 because the cost price is to be cancelled. Then after simultaneously we have to cancel CGST and SGST of 10,800 in each case, and that is why their accounts are credited over here. Then friends, here what happened, that only 60% claim is admitted by the insurance company. Therefore, the entire amount cannot be debited to insurance company accounts. The whatever claim is admitted by the insurance company, that we will debit over here. So, insurance company account debited by 84,960 and the remaining amount is our loss, and that is why we have to transfer it to profit and loss account 56,640. And now finally, the whatever account we have opened over here to loss of stock by fire account will be closed. So, 60% claim is admitted by insurance company. Abnormal loss is of rupees 56,640 debited to profit and loss account, and here the loss of stock by fire account is closed. Now friends, here the whatever amount is admitted by the insurance company, and now insurance company will make payment to us. So bank account will be debited by 84,960 and insurance company account will be credited by the same amount. So amount received from the insurance company and its account is closed. Now disclosure in final accounts. Here purchase is reduced by 120, so we have credited it. Here input CGST and input SGSTs are also cancelled, 10,800 in each case. It is not sellable because these goods are not in existence. Insurance company has paid only 84,960 rupees and that is why its account is debited. Partial insurance is received, so 56,640 we have debited, it is not received, thus this loss is transferred to profit and loss account. Now friends, we will see the third case when goods were not insured. In this case, the entire loss is transferred to profit and loss account. Here, when loss has taken place, loss of stock by fire account will be debited by 1,41,600 to trading account cost price, to input CGST account 10,800, to input SGST account 10,800 will be cancelled, and entire loss will be transferred to profit and loss account because we have not taken any insurance for that. So profit and loss account will be debited by 1,41,600 to loss of stock by fire account credited by 1,41,600 rupees. The entire loss of 141,600 is debited to P&L account and loss of stock by fire account is closed. Disclosure in final account, we have to cancel purchase by rupees 1,20,000 and that is why we have credited. We have to cancel our input CGST and input SGST each by rupees 10,800 and that is why we have credited them. It is not sellable because these goods are not in existence. The entire loss is debited to profit and loss account, rupees 1,41,600. Now friends, in part 6, we have studied about adjustment with their accounting treatment and disclosure in final accounts, and these adjustments are provision for discount on debtors, manager's commission, interest on capital, goods withdrawn for personal use, goods distributed among staff for their welfare, and abnormal loss of material. Dear friends, appropriate understanding about adjustment makes your study about final accounts very precise and correct in reference of accounting principles, concepts and conventions. Keep on revising till acquire desirable understanding. Now in next parts, we will study final accounts with inclusion of different types of studied adjustments. Wait for next part. Thank you.